The Federal Reserve kicks off its two-day meeting in Washington this week, with traders dialing back rate cut bets following the latest jobs report, which did top expectations. The meeting comes after President Trump renewed his calls for Powell to cut rates in an interview with NBC over the weekend. Here to discuss, we've got Jeffrey Roach, LPL Financial Chief Economist. Great to have you here with us. And ultimately, as the Fed is going to have its May meeting this week, do you anticipate there's anything that they would see in the data to actually signal that we could start to see some of those rate cuts be talked about at this juncture?
Well, thanks for having me on, Brad and Madison. I think what's going to happen here is it's going to be somewhat of a boring meeting this week. I think what they're going to probably do is use their speeches. They're going to be literally all over the world. The various policymakers will be giving speeches both in Europe, domestically, and they'll use those speeches to prepare markets to expect the first cut to come in June. So no change, obviously, this week. Inflation is still nagging, although we certainly saw some positive moves in what they call the super core. So core services, housing. That certainly is moving in the right direction. I think we'll see three cuts: a quarter cut in June, and then October, December.
Help me understand the state of the labor market right now, since you bring up some of the numbers that we got in the jobs report. Some of the uptick that we saw for things like warehousing, those were temporary roles that could potentially be part of a pull forward dynamic ahead of any negative impact of the trade war. To what extent do you think that there's a discounting right now of a broader potential weakness in the labor market to come?
Well, I think last Friday's report was probably a little bit misleading. So remember, and I'll address the temporary workers, but also a hot topic is on the federal side. So any federal worker that's getting paid severance or taking an early pay cut, or early leave, they're still on that payroll. So we're probably going to see some impacts from the DOGE cuts in upcoming reports. Didn't really see much impact yet on federal. I think one thing that's providing some stability is the hiring demand for healthcare services. That's certainly not going to be temporary. But granted, this report was probably a little hotter than what's really happening, masking some of the slowdown in labor markets. I do think that the trend that we've seen really for the last year and a half, that the average pace of job gains is slowing. But as long as we stay above the 125K level, I think that's communicating to investors that we're seeing some stability despite the slowdown.
And so what most notably are you keeping tabs on with relation to business opportunities, or I should say employment opportunities and prospects, as consumers are viewing the economy and trying to figure out, okay, do I feel comfortable spending at the same propensity I would have had previously if I'm not sure what hiring is going to look like in my industry?
Well, I think one thing that's helpful for those looking for jobs is, we had a tight labor market the last several years. I think we know businesses had difficulty in hiring qualified workers. So I think that that's still somewhat of a concern. So as we go through 2025, I think businesses are going to say, look, we worked really hard to find qualified workers. We're going to keep them on the payroll. Maybe average hourly earnings is not going to rise as fast, but we're not going to be as quick to shed payrolls because of the qualified worker shortage.
And talk to me too then about the uptick we've seen in people staying unemployed for longer. Where do those individuals find hope when companies are pausing on things like hiring, to your point, to focus on just keeping the workers that they currently have?
Well, we have seen a quick increase in long-term unemployed, but when you look at that longer term chart, in fact, you're showing it right now, you go back maybe, 2023, 24, we're going back to those pre-pandemic levels of, a little higher than 23% long-term unemployed. That's certainly concerning, the speed at which we got back to those pre-pandemic levels, but we're not necessarily at recessionary levels yet. And I think that's why we saw markets respond so favorably after that Friday payroll number, that, perhaps labor markets certainly slowing down, not necessarily contracting or falling apart.
Jeffrey, great to have you here with us today. Thanks for joining us just after the open.
Thank you.